Giving personal financial advice, what is the practical wealth preservation playbook here? I mean, how should people think about physical metal, cash, risk assets, allocation, but also liquidity and the emotional risk of buying after a major run?
Right. No, these are the important questions. And I think, obviously, take gold and silver out. You already know my answer to that. We think very strong and high allocations of gold and silver. That's obvious. We're not alone. Even the big banks, even Morgan Stanley, UBS, Goldman Sachs, they're even in some cases more bullish on year-end price targets. But we're not looking at the price, but their allocation levels are extremely expanding, which is fascinating in of itself. In Switzerland, 20% gold and silver is a minimum. 80-20 gold and silver, 20% allocation, that's a minimum. When you get beyond the obvious conviction, not bias, I have for gold and silver that Egon and I have, that all of us have at Von Greyerz, the other assets are what our grandparents told us. Our grandparents who went through, especially here in Europe, who went through inflation, debasement, military crisis, distrusted governments. You want an asset that can't be printed or mass produced or paper claimed. You want hard assets. I think, as Ronnie Sturfler said years ago, we are heading into a commodity super cycle. You don't have to get the day right. You have to get the direction right. I think hard assets in general are a safer store of value and a longer term play if you're not a speculator, but an investor, if you do understand the direction of the hockey puck here. I think real estate in particular, agricultural real estate, massively important. These are important assets. It's the hard assets. It's the things that can't be manipulated and claimed and debased that I think are the longer term plays. Obviously, you want to have dry powder, but dry powder for what? Dry powder for when there's a mean reversion in this market, if the markets aren't nationalized. But dry powder can be sucked away by inflation. So I get that there's a real sense of no place to hide. In an absolutely bloated bond market, it's a bug looking for a windshield, and a massively overvalued stock market, it's kind of hard to hide and wait for a mean reversion or hide in a safe value asset or a safe value stock. Of course, there's going to be speculation opportunities in tech. There always will be. But I think for the patient investor, I would do what central banks are doing. I would save in stores of value, commodities, and precious metals in particular. I would spend in fiat when you actually see a buy signal. I've always said, if you go duck hunting, you don't walk out to a duck blind or row out in a boat and just point your 12 gauge into the air and shoot. You actually wait for a duck. And so sometimes the hardest thing is to do nothing. Once you've preserved your purchasing power in hard assets and precious metals, then you have to do what a patient sniper or a patient hunter does. Wait for your target. Don't just be shooting at everything that moves. That's very hard to do when you're trying to get some type of return, when you're stressed out and you're speculating like a gambler in a casino to get through the year. And I understand that pressure. I don't think speculation is the safest way to get it at this point in the S&P's history, in this point in the bond market's condition. I think it's a dangerous game.